It's awesome really again. And today we're going to go over stock price and how it correlates to options in regards to strikes and expiration selection. How you know which strike to pick and at which expiry. So right now I have Netflix pulled up. As you can see, it was a very red day for Netflix today. It was a very good trade if y'all would have traded it. I just want to go over what I saw in Netflix is, as you can see, it hit this little high here that it could not break above. It went down, bounced off this SMA line during pre-market, could not reach those previous highs. So therefore, you had this little golden cross here, and that was a clear entry for a short for the day. And we're looking at about, I think it was 200%, something like that, gain for the day. So that's what Netflix did today, but that doesn't really matter what it did today because by the time you watch this, it may be a year from now, and that's not actually what it did. I just thought I'd go over it for the day. So now when you're picking a strike price and expiry, so the strike price really depends on what you're trading. So like if you're going to be a swing trader, let's say you want to hold it for a day or two or maybe even longer, like a month. Okay, first off, I would not recommend holding a single naked option for longer than 2 or 3 days because you have to keep in mind theta. Okay, so theta is one of the Greeks in options where each day you're subtracted by that amount. So let's just go here and I can pull it up. So I'm going to switch up my volume with theta. If I can find it, I don't have it up a lot, so I don't really know where it is. I wish I could pull this up for you. Oh, Greeks, here we go. Theta, okay. So the theta here, let's just use this one, negative 0.44, okay? So this is at a, I don't know, about $17 option, okay? But each day it is decreasing by 0.44. So let's see what 0.44 of 17 is. 0.44 divided by 17 times 100. Okay, so that is 2.3%, okay? So in order to cover your position just to stay neutral and not lose any money, your options contract has to increase by 2.58% each day just to not lose money because of the theta. Theta increases as you get closer and closer to your expiration. Okay, that's why if you look far out, you have contracts going for $4,700 a contract, and you look at the weeklies and they're going for, let's see, where's the price? They're going for eight bucks. $8 versus 58, 60, $70. Like that's crazy, okay? So that shows that theta is very prevalent in trading. So if you're going to swing trade, I recommend you either, I don't know, selling some spreads or doing some type of strategy like an iron condor, something to prevent this theta. When you're day trading options, it doesn't really matter because you're not going to see that theta experience. You're not going to hold it overnight. So you're not going to see that subtraction in your contract price. Okay, so that's the first part. If you're swing trading, pick something that is further out with a lower theta. Okay, you want your theta to be low when you're swing trading because you don't want to lose all the money or the contract price as you're trading it. Okay, so you don't want it to, I don't know, make a 10% move, but you held it for 4 days. So the 2.5% times the 4 days is 10%. So you came out even though you were right. That's something you don't want to happen. Okay, so make sure that if you're swing trading, your theta decay will be covered even when it reaches your target price. Okay, now if you're day trading, you want to be in these first two. You want to be in the weeklies, the ones expiring the soonest, for a few reasons. First reason, to reduce cost basis. Let me go to SPY here. So if we go in the most recent ones, we're looking at contracts that expires today. Let's not do that. We're looking at contracts that are $88, $123. So reducing cost basis means that we can get more contracts or basically do more with our money. So for this instance, we only need $123 to enter this, or my bad, it's going to be a spread. So we only need about $125 to enter this position here, or to get a contract here. While if you wanted to day trade and you were trying to day trade this monthly, you would need at least $500 just for the same position, which is not beneficial for your cost basis or the money that you want to put in. It limits your risk per se. Also, when you're day trading, you want that huge volatility. You want the percentage gains to be huge. Let me pull up the percentage gains on SPY today. Okay, 260% for this weekly, and for this weekly, 400. Of course, it was more, but since it's expiring today, it's going crazy. So we want to see this percentage gains, which is not necessarily as huge the further you go down. So you're seeing 40%, but then again, you have to pay $852 for this contract. So when day trading, you want to select an expiry that is close, preferably a weekly, so that you can see that volatility and you can get in and out quickly. Okay, so now we know how to pick the expiration for a weekly and or for a day trade versus a swing trade. Now let's look in the strike price. Okay, when you're day trading, the strike price does not matter. Okay, as you can see, let me go. That expires today. I'm sorry. So as you can see, this is an out of the money put, right? This is an out of the money put, but it still increased by 275% today. You do not need to be within or in the money, at the money, to make money day trading. Okay? You just want to buy it at a low price, and you want it to increase. It doesn't have to go to your strike price. You can still make, obviously, 275% back. Swing trading is the same thing. However, you want to be closer to the at the money. Okay? Because if you're not closer to at the money, then your volume definitely decreases. Obviously, this is not going to be the case because right now I'm in SPY. Let's look at something. Oh, Tesla's going crazy. Facebook, for example. Let's go out to a monthly here. Okay? So if you look at stuff that is outside, that is super far in the money, we're looking at 87, 256 for the volume. And of course, this is crazy, but 1,000, whatever, okay? But usually these outside areas have less volume than the at the money volume. So if you're going to buy a swing trade, you want to make sure that your strike price will be that your target, where you want the stock to go, you want to choose that stock price. So let's say you're trading in between a support and resistance. So let's see if I can find something here. This is Facebook. Let's say you notice that it hits highs here. Oops. It hits highs here. It hits lows here. So you scoop up some options contracts on the lows here to sell at the high here. Where will your strike price be? Since you're going to swing trade this, you want your strike price to be a little lower than your resistance. So 160. 160 would be a great strike price, because when it gets to 160, now you have all the at the money options, which are trading and they're super volatile, and they're all there, and they want your contract, because you want to make sure that you can get rid of these contracts, because option contracts do not go as quickly as stocks. Trust me, you cannot click buy and sell and automatically goes like that. Okay, you want to make sure your liquidity is there. So when you're swing trading, choose a strike price that will be near the resistance that you can see your stock going to. Okay, let's go back. Obviously, strike price does not matter, and well, I mean, it does matter. When you're doing strike price for the weeklies, you really want to look at the open interest. Obviously, look, the open interest here was 2,000, and we had the largest volume. Okay, let me show you. I think an example here was maybe SPY. I don't know, something. Let's go look at the weeklies here. Well, this is going to be obviously skewed because SPY is crazy on volume. Oh, Tesla, that's a good one, I think, hopefully. So look here. We have 1,000 open interest, 5,000 volume. So 1,000, 1,000, 128, 935, 80, 471. Obviously, this is an outlier here. But when you're trading, day trading options, you want to make sure that you're picking the closest out of the money option with the highest or the largest number of open interests, because that is just a tendency for the most volume. The reason why is because if you haven't checked out my previous video on open interest and volume, is that open interest is the people who have contracts, and volume is the people, of course, who want to buy and sell those contracts. So if you want to buy and sell contracts, go to the masses that actually have the contracts. So that's why we choose when day trading the largest, the one with the biggest amount of open interest. So that is how you pick the strike price and the expiry date for swing trading and day trading options. I hope that helped. If you want to join a Discord group, that will be below. It is Options Traders, and we can answer any and all questions. The only thing we ask is that are helpful to other people once you start learning, as we will help you learn. So I hope everything works and that y'all are successful in trading this new market that we are in. Y'all have a good one.